Hi, it's Daniel Bisgear, CFO of Constellation, and you are listening to the CFO Thought Leader Podcast.
This is episode 1097.
I think sometimes we've fallen back to where we've, basically stayed, kept doing things the same way and not really taking advantage of the technology that's there. And as a result of that, we're making investments and not really driving the benefits for the organization. The other thing that I want to make sure that we do, and it's something that we started to focus on about 18 months ago, is really measuring and ensuring that we are achieving the benefits that we set out. Before we outlay any capital for any product, we sit back and say, what are the benefits that we expect to achieve? And then we got to make sure that we're then, as we do the KPIs on those, that we're actually achieving those benefits. And if we aren't achieving the benefits, let's pull the plug early on. Let's not continue down the path. So make the hard decisions earlier on in the process, and it's the right thing to do from the business.
For nearly 10 years, Kevin Ingram knocked on S&P's door, arguing that FM's A+ rating undervalued its balance sheet. Other rating agencies, such as Fitch, had rated FM as AA. Each visit, Ingram presented fresh numbers. Each time the agency hesitated, wary of making a change. Last summer, 6 months after FM dropped global from its name, S&P finally moved, lifting the insurer to AA-, a vindication of sorts. Along the way, Ingram tells us, he championed a philosophy that capital is our product. FM's capital, he tells us, climbed from $12 billion in 2014 to $26 billion today, while its exposure grew far more slowly. You'll hear that and much more on today's episode. Our talk with Kevin Ingram begins after this.
When it comes to company spend, most finance teams are on defense, reacting to surprise spend, chasing receipts, saying no. But there's a better way. Meet Brex, the AI-powered spend platform that boosts a company's control, earnings, and speed. 99% of customer spend is compliant. 11 million hours saved on expenses and accounting through automation. $681 million plus back to customers in business building rewards. Make every dollar count with Brex.
Hi, it's Jack. Today we welcome back Kevin Ingram, Chief Financial Officer of FM, the commercial property insurer, formerly known as FM Global. Since becoming CFO in 2016, Kevin has overseen capital management, finance operations, and risk modeling over more than 25 years with the company. He has also led FP&A, international finance, and corporate services. Kevin, welcome back.
Thanks, Jack. It's great to be back.
So we have to begin with the rebrand. And we're curious, and I'll put it this way. What strategic gaps did and I think it was July of last year, July 2024 rebrand from FM Global to simply FM aim to fill? What were the gaps it aimed to fill?
Well, look, so it's interesting. The name FM Global was what we chose in 1999 when the company was formed, merger of three mutual insurance companies together with two jointly owned subsidiaries. And we named it FM Global because we wanted to make sure we were a U.S. domiciled company. We wanted to make sure that our policyholders and the various constituents that we dealt with knew we were global, understood we were a global organization. 25 years down the road, we no longer need to tell everybody we're a global organization. We are a global organization. That's clear with, the breadth of the business that we have in place. So we said, look, FM is really the more appropriate name for us. And so we went through the process of rebranding as FM versus FM Global.
So S&P upgraded FM to a AA 6 months after the rebrand. Is that right? Do I have that right?
Yeah, AA-, yeah.
AA-. Okay. Which capital management shifts or model refinements were perhaps most influential in earning that upgrade?
It's interesting. I mean, maybe I'm the wrong guy to ask here because I have a biased opinion or biased view of S&P. Look, S&P is one of the three rating agencies that we deal with on the insurance, from an insurance company perspective. And, we have had our rating with S&P. We were rated A+ from S&P since 2014 or 2015 when we were first rated. My personal view since that time was that rating was too low. And so I've been talking to FM for 10 years about the fact that the rating was too low and why it was too low. And over that period of time, our capital has just grown. Our capital has grown from, the range of $12 billion to $26 billion now. And our, the size of our exposures that we underwrite haven't grown anywhere near the same rate. So as a result of that, I've been beating on S&P for 10 years about the fact that the rating, I felt was not high enough. It should have been higher. The rating we have, one of the rating agencies we deal with is Fitch, and Fitch has us rated as AA. So finally, S&P kind of came to the table with. They agreed with us early on in the process. S&P's position was, look, if we change your rating, so soon, it would be like admitting our rating was wrong. And I said, well, that's because your rating is wrong, and it should be changed. And they weren't willing to admit that. Look, the fact of the matter is the company has grown. The company has been, hugely successful over the last, 6-7 years. S&P has finally recognized that, and it's been reflected in the rating. And so it's something we're pleased about, and it's something that we are certainly very happy, with from a marketing perspective. But it's not going to make a big impact to the business.
Now, you have often linked engineering spend to lower loss costs. Has the rebrand altered or sharpened the metrics you track to prove that equation? Let's call it.
No, the metrics haven't changed at all. I mean, the rebrand. Look, when we went through the rebrand process, there was one person in the corporate office that said, "Look, I don't think we should do this. I think the brand is fine." That was me, because being the CFO, I didn't want to spend the money we needed to spend to go and go through that whole rebranding process. Having said that, it's been a huge success for us. We have gotten, a lot of leverage, a lot of mileage on the new brand. I think it's, much sharper logo than what we had before. I think, I think it will pay dividends for us down the road. But, there's really been no change to the underlying fundamentals of the business from an engineering perspective, how we manage, how we monitor, how we track, the benefits of the organization haven't changed at all relative to the rebranding effort.
So, FM, and I'm grabbing some stuff from headlines over the last few months, you launched a renewable energy unit and folded some of the entities under the same umbrella, cargo, boiler, and machinery. And I'm wondering, how does finance sort of balance the capital between these different risk pools?
The great thing is everything we do relates to commercial property. So there's nothing we do. We don't have, we write one line of business, which is commercial property coverage. That business is split into, we segment it into different areas, like the renewables book, or like, the cargo book, or the mutual boiler book, or the, FM affiliated book, the mid-markets book. But, from a capital management perspective, everything we do is driven by, is done for the benefit of our commercial property policyholders. So we really are, really look at things from from a capital management perspective, looking at it from one line of business with multiple subcategories of business below it. So for us, the allocation of capital is not a particularly onerous process. And part of that's also because our level of capitalization, if you look at, say the Fitch rating report or even the S&P rating report, they both say we have AAA, level capital. Our capital is very high relative to the level of capitalization of our peers. And the exposures that we have, the leverage that we have. And so as a result of that, there's not a capital allocation is not something that we spend a lot of time stressing about.
Yeah. And from what I understand, FM's mutual structure lets you prioritize retention over quarter to quarter earnings.
Yeah, and it also allows us, Jack, to not focus particularly on top line. What's our revenue base? What are we doing? So I don't need to worry about shareholders or analysts and other folks out there, looking at what our revenue is doing and what our growth trends are. We can sit back and say, look, we want to make sure instead of us chasing, $1 of revenue, let's, a target level, let's make sure if we're growing, if we're writing new business, let's make sure we're writing business with the clients that are aligned with us from a risk improvement, from a resilience perspective that are going to, leverage the engineering services that we provide and really should be part of that mutual organization and really, work with them in that regard. So for us, the mutual structure allows us to not focus on that quarter to quarter, month to month, revenue, but also profitability. I mean, so do we need to be profitable? Yes, we have to be profitable. If you're not profitable, you're going to go out of business. But at the end of the day, we can withstand much more volatility in our results than other organizations can because we're a mutual versus stock company. So as a result of that, we can have higher retentions, and we do have higher retentions than our peers have from a total limits that we provide and how much of the limits that we retain before we go and we place reinsurance, go out and buy insurance protection for ourselves, which is called reinsurance. So we have much higher retentions, and we can withstand that. We can take those retentions because of our mutual structure and the level of capitalization that we carry. Does that result in additional volatility? Yes, it absolutely results in additional volatility for our results. But from a long-term perspective, it has proven to be the right structure for us, relative to capital growth and profitability.
Yeah. Under that, the mutual structure, though, as we, in an inflationary environment, let's say, can you give us some insight into your decision-making, how you go about deciding when to absorb costs for policyholders versus passing them through rate changes?
Yeah, so we have to be, even though we're a mutual, we have to be market competitive. Our pricing has to be market competitive. If the insurance market historically, the property casualty insurance market has been very, very cyclical, over time it goes up and down. And lately we've been in a hard market, so rates have been going up. We feel like have our rates gone up over the last 5-6 years? Yes, they absolutely have. We don't think they've gone up as much as other companies' rates have gone up because we've been able to manage some of those increases as a mutual policy, as a mutual insurance company. But also when rates went down, we don't believe our rates dropped as quickly as other companies' rates dropped because, did our rates drop? Yes, but we don't necessarily believe that they dropped at the same rate because, again, we have to be market competitive. We're never going to be the low cost provider because of the ancillary services that we provide. But we do believe that our mutual structure allows us to be a bit more flexible with our clients about what's going on. Now, relative to the inflationary environment that you're talking about, a bigger issue for us or for any insurance company is going to be, loss cost, right? So because of what's going on, we'll say with Donald Trump right now, the current administration with tariffs and what all that's going to mean with steel and all the other products that you're going to need. If we have a client who has a fire and their location burns down and we need to reconstruct that, the cost to reconstruct that, if the tariffs, hold in place at the levels that have been proposed, that's going to be a higher cost for us to rebuild those facilities. The same thing for our competitors are going to have the exact same issues. And so those are things you have to factor into your loss cost, process as you price your policies, as you set the premium that you need to basically, receive to cover those expected loss costs as we move forward. So, certainly, are we in an inflationary environment? Yeah. I mean, will the tariffs cause inflation? I think initially maybe it depends how they bed out and where we ultimately end up. But I guess it's a bit of a kind of let's watch this space and let's wait and see. I think the jury's still out. We need to wait and see how things shake out. But there certainly will be an impact on not just us, but the whole industry, depending on what the loss costs, how loss costs change as a result of tariffs coming down the pike.
When we last spoke, I believe we were coming out of COVID, and it was in the rear view, but here we are. I forget where FM was as far as a hybrid workforce. Did you folks adopt sort of a model there? What was your?
Yeah, we were initially, with the pandemic, we were closed. We were 100% remote. And we had gone from 100% office space prior to the pandemic to 100% remote, when the pandemic happened. And we didn't start bringing people back into the office until, you and I spoke in 2021 sometime. So it might have been just about the time we started bringing people back into the office. But even when we did that, it was on a, 3-day-a-week basis kind of thing. It was very, very fluid, very flexible. We've since moved to where we've gone back to being an office-based employer with flexibility. So what that means is if you need to work, if there's something you have going on, you need some flexibility, we will allow you to work from home to address whatever the situation is you need to work from home to address. But we do expect people to be in the office generally 5 days a week. with my finance staff, we're at a 4-day a week in the office basis where everyone's in on Monday, Wednesday, Thursday, and they either opt in, they can work virtually on either Tuesday or Friday, depending on what their schedule allows them to do. That gives us 3 days in the office with everybody in the office together for 3 days a week, which provides for collaboration and impromptu meetings and all the other benefits you get from being in person.
Were there any productivity metrics, Kevin, that led you down to say, okay, let's move more to a working place?
Yeah. I think the biggest thing is like what I just touched on. I think it's, it's funny. What we saw was our not surprisingly, are people that are, maybe, say early 30s to mid 40s were the ones saying, look, I can do my job just as effectively remotely as I can in person. And our response to them was, yes, you can. And the reason you can do that is because when, before the pandemic, we were an office-based employer. And so you were working with people who were in the office with you and they were answering your questions. There were impromptu meetings, there was collaboration, there was cross-hitting, there was all that thing happening. When you were virtual, we're 100% virtual workforce, everything is scheduled. There are no impromptu meetings. There's no minimal cross-training. There's minimal, collaboration. Collaboration has to all be scheduled. And it's a much more difficult environment. And we felt it was going to affect long-term, have a big impact on our culture. So we needed to get back to getting people back in the office working virtually, or instead of working virtually, to allow us to better serve our client base.
We wanted to touch on AI with you, Kevin. It's something we've been talking to all our finance leader guests about. And perhaps just to begin with sort of a broad one, how has this organization integrated AI into its strategy? And what initially is driving the decision to invest in AI type?
Yeah, we have, a large number of engineers on staff that go out and inspect our insured facilities on a daily basis. You mentioned it before, and that's a service that we provide. We're unique in the industry in that regard. And as a result of that, those engineers, when they do inspections, and they're out every day doing inspections, they write what are called loss prevention reports. Those reports, include hundreds of data points on our insured facilities as far as the risks, the relevant risks that are there, construction type and what their exposures are, and machinery equipment exposures, and natural catastrophe perils, and all kinds of things, anything you can imagine, right? So we have more data available than any of our competitors have about the exposures that we have. We also have been around for 180 some years. So we have all kinds of, unfortunately, all kinds of loss experience, right? So we know what causes the loss. We know what the perils, the types of loss occur, what causes those losses to occur, what the engineering solutions could be implemented to avoid those losses from happening. So we can marry that loss information with the engineering information to better serve our clients. So we can use AI, and we have used AI to really better deliver those engineering services and the loss prevention services to our clients and marry it to the loss data. So we can, a great example is prioritization of risk improvement. So that engineer, when he goes out to visit a site, he writes a loss prevention report to help us underwrite the business. But we also provide a copy of that report to our clients. And in that report, we can prioritize the recommendations we make to make that facility more resilient, to make it less susceptible to risk. Whether it be fire or wind or flood or whatever the peril may be. And so we can prioritize that based on our loss experience to help them understand, if you're going to spend money, do these 3 or 4 items first, because you're going to have the most bang for your buck there. And that's something that's much easier to do in the world right now with AI than it was previously.
Hey, we're wondering, as a finance leader, whether there are other department or functional areas where suddenly you are being asked to invest, because here was something we could do differently if we could just beef up our AI capability. Is that a conversation that's, common or not really?
Yeah, no, we've ramped up our AI resourcing absolutely as a result of what's gone on over the last few years. Having said that, we are very, very sensitive to, because we have a lot of client data. I said, those engineers go out and do inspections. And so we get a lot of information from our client locations as a result of that the inspection work that we do. So we need to protect that data. So what we've done is we've shut down our employees' access from our systems into those various, chat GPT type tools. What we've done is we built a sandbox where we let people, kind of work in our own sandbox and utilize AI so we can control the data, the flow of data back into the world. Because once it gets into chat GPT, you've lost it. So if our data sheets get into ChatGPT or another tool like that, we have lost those data sheets. They're now in the public domain, and they've historically not been in the public domain. They're things that are proprietary to our organization.
Just as far as your finance operations is concerned, then where is AI having the greatest impact on your finance function?
Look, I think it's the same with us as it is with any finance organization, right? So the menial tasks, right? The financial statement reviews and the writing of footnotes and the kind of review of information, the transactional, items that we do from a finance perspective that happen all the time. A lot of those things can now be done with AI versus having people get in there and actually enter information and stuff like that. So there's all kinds of valuable AI resourcing that can happen that you can bring to the fore from a finance perspective, which I think have made a big difference for us and for other organizations.
FM, your 2024 outlook, I saw something about rapid AI adoption as a top trend for your industrial clients. So you're looking at your clients, you see them really putting the accelerator down. And just from a finance lens, your rebrand during this time, is the new brand helping you package some of your AI-driven services? What do you think?
I think the rebrand is just, just plain that, just simply that, just a rebrand. And I think the AI stuff was going to happen regardless of whether the rebrand happened or not. I don't think we're getting any more traction or less traction relative to AI as a result of the branding of the organization.
So we'll put you on the spot with this one. What single KPI or dashboard will tell you in 12 months that the rebrand succeeded, both financially and culturally?
I think there's not a single KPI that you can point to say that it succeeded or didn't succeed. I think there's a lot of different indicators that you can look at, touch points that you can look at as to how successful it was and what the market reaction is to it, right? And a big part of that's going to be talking to our clients and really understanding better from our clients their views and how things, what their reactions were to it. And so as a mutual insurance company, we have different product lines, as I said before. But the biggest product line we have, so we have our revenue is about $11.2 billion. Over $8 billion of that is coming from 1,600 clients. So it's really what our main focus is going to be is what's the reaction of those 1,600 clients to that rebranding? What's their views? Has it been a positive experience or not? And there's a lot of touch points we have with those clients. And I think for us, it'd be easy for us to understand, the benefits of the rebranding. And so far, everything we've heard have been very, very positive. Was it worth the cost? As a CFO, I think the jury's still out on that, but I think our CEO would tell you absolutely it was worth the cost. It was a lot of leverage from. So,
Kevin, as a finance leader, and just sort of on a personal level, how do you reach out to clients or customers? I'm sure there's ones that you have relationships over years, and perhaps they're your go-to clients where you can get it straight up when you need it. But I mean, do you play golf? Tell us something about your approach to getting your lines of sight into those client relationships on a personal level.
Yeah, there's a couple things, Jack. So the answer to your question is yes, I do play golf, and so I do take advantage of the opportunity to golf with our clients. Generally, many of them are CFOs or chief legal officers, CEOs, and presidents of organizations. So I certainly do that, on occasion. But a bigger thing for us is we have what are called advisory boards. And we have our main board of directors, which is comprised of 11 individuals. 10 of them are unaffiliated directors from client organizations. But we also have 8 advisory boards around the world. And those 8 advisory boards have anywhere from, 12 to 20 members on it. So we have 130 to 150, different client, representatives on those advisory boards. And every February and March, I go out and make presentations to every one of those advisory boards. So I have a lot of exposure to clients. And so you're talking about our prior year results, what our plans are for the current year, and just walking them through, giving them better understanding of what's unique about FM Global, or FM, I guess, we'll call now, sorry. what's unique about FM, and what's what our business, our value proposition is, and why, how it works, and help them better understand not just FM as an organization, but also the insurance industry. And so I am very fortunate in that regard. And the other thing that we did last year, we really started this. We for the first time ever sponsored an LPGA event, and it was Labor Day weekend in the Boston area, right? And it was something that really our clients really resonated with. Our clients really got a lot of.
Were you in attendance? Were you there?
I went. I played in the Pro-Am. Actually, it was great. Didn't play well, but I played in the Pro-Am. I was there all 4 days of the tournament. We had clients that participated in the Pro-Am with us. It was something we got a lot of mileage out of. We signed a 5-year contract with the LPGA, so we'll do it. 24 was the first year, and the great thing, something I'm quite proud about, is that our organization, our tournament, is the largest non-major, non-tour championship purse that on the LPGA tour. So we are having, it's a substantial impact. We have a lot of women in our organization, so from a diversity perspective, we think it adds a lot of value. From a STEM perspective, with science, technology, engineering, mathematics, we think there's a lot of leverage that we bring into that as well. With our employee population, it's based here. Tournament's actually just up the road between Providence and Boston. So it's something that's close. A lot of our employees volunteered to work the tournament. So it's been something that has paid huge dividends for us, right? And so that's another way where I've gotten exposure, not just to our clients, but also to our broker partners, right? 2/3 of our business, probably 3/4 if you include our mid-market business, is brokered business. And so maybe even 80%. And so our brokers are big partners of ours as well. So I spend a lot of time working with not just our direct policyholders, but also our brokers that are involved as from an intermediary perspective with those clients. It's been very valuable in that regard too. And I think we'll get a lot of leverage out of this LPGA event as we move forward as well.
All right. So I just want to alert listeners to the fact that we covered your career journey, your early years in our earlier podcast. So I don't necessarily want to go back in time with you, but I do want to understand better how you view this latest chapter of your career. And here's how I would break it out. It's become sort of the common dividing line for so many, COVID. You entered the office in 2016. You had 4 smooth years, and then COVID arrived. I'm not looking for here's how we manage COVID story. We've had too many of those, Kevin. But what is this chapter since 2022, let's say, forward? What is this the rebranding chapter? Is this the AI chapter? What is this chapter of your career as you look at it now? What do you think it's going to be?
Yes.
What's the milestone that's going to define it?
Yeah, it's a tail end of my career. I'm approaching retirement. I've been with the organization 35 years actually this year, and it's been a great run. As I said, the insurance industry is very cyclical. So we are at a time now where FM Global has never been stronger from both a current financial perspective, but also the strength of the book, the quality of the book of business that we have. I'm at a point now where we are at the peak of our existence, and there's nothing to cause me to believe that will not continue into the future. But we are in such a strong position right now relative to our peers and the marketplace that we operate in. And so for me, it had nothing to do with COVID. It really just came down to doing the right things and making the right decisions. We went through a re-underwriting process. We had a tough period of time in 2017 and 2018 where we had some poor operating results as a result of some big natural catastrophes and some other things that occurred. And as a result of that, we needed to re-underwrite our book. And we went through that process and spent about 4 or 5 years re-underwriting our book. And as a result of those efforts, very, very difficult efforts that we undertook from an operations perspective, we have never been in a better position from a financial perspective than we are today. So I think what we're dealing with now is we're dealing from a position of strength. And so where we are now is just kind of being opportunistic and making sure that we don't basically slide back to where we were in the soft market years in 2014, 15, 16, 17. And now let's take advantage. Let's make sure that we learned from our mistakes and don't regress back to where we were.
Kevin, what comes to mind when we ask for a finance strategic moment?
Look, I think it's funny with insurance companies. people don't really think about what's our product, what is it that we do. And so the way I explain it to people is our product is our capacity that we provide. And so when I talk to, whether it be my peers at my company, when I talk to clients, I go out there and I really spend a lot of time endeavoring to help them understand what's unique about us and what's the product we offer. And the product that we offer is our capital, our capacity. And our capacity is driven by our capital plus our reinsurance. And so I help them understand what our capital is doing, how strong our balance sheet is. I'm able to share information with them. So for me, what I learned is how to really talk the finance language, how to provide laymen, whether they be, legal folks or risk management people or marketing people, help them better understand what it is that we do from a product perspective. And so that's something I've been doing. What it's allowed me to do is really kind of demystify the world of insurance. And so what I can do is get it down to a kind of a conversational topic. And as a result of that, what I've done is I've really better helped, enable my peers in the organization. So my coworkers my account managers and my operations managers to have similar conversations. Once they see how I talk to clients about capital management and what we do from a capacity perspective and how we differ from our competitors, they are then better able to go and have those exact same conversations with our clients and with the folks that they deal with on a daily basis. I may see once a year, they see them every day.
I think what you're telling us, though, is the language you use. Because my question for you is, well, how do you discover that language? Because you're sort of in the zone. Your colleagues every day use the same language. How do you get out and realize how to make, the light bulb go off in people's heads when you discuss these? I don't know.
Yeah, a good example, I think, Jack, is, like when I'll talk to I do these advisory board tours, and I'll talk to probably 3/4 of the people on our advisory boards are CFOs. And I'll go in and I'll say, look, I'm going to talk to you as a CFO. I'm going to tell you, if I was a CFO of a client, here's what I would want, what I think I should know. Here's what I think you should know as a CFO of a client. And I explain to them things. I've had some clients come up to me and thank me for helping them better understand insurance. And so it really is, for me, it's just trying to talk speak the same language, right? We're CFOs, but they're not insurance CFOs, right? And no different than I'm not a tech CFO. So if I was on an advisory board for a tech organization, I would need somebody to help me better understand the technology angles there versus the insurance angles that I have experience to. So I think what I'm able to do is I'm able to talk about, our balance sheet. I'm like, look, capital is our product. So like I said before, the big thing is the product we offer is capacity. The capacity we provide is all driven by our capital and the reinsurance that we buy. So what does that mean? That means, how good is my capital? Well, how good is my balance sheet, right? As a CFO. So there's two risks from a if you think about it from an insurance perspective to your capital. One is your assets are basically overstated. So what's the risks that your assets are overstated? Well, our investment portfolio is all marked to market. So as a result of that, since it's marked to market, there is zero chance. There's no chance that our assets are overstated relative to the investment portfolio. The second largest asset that we have and most insurance companies, if not all insurance companies have, is reinsurance recoverables. So what's the risk that the reinsurance balance that we're due from third parties are going to be uncollectible? So I talk about the fact that the average duration of our liabilities are unpaid losses, because we're property only insurers. We generally, if a loss happens, if there's a fire today, we're gonna rebuild that facility over the next 18 months. So it's going to be fully paid and settled within, worst case scenario, 2 years, maybe 2.5 years. So the duration of our liabilities is very short relative to other insurance companies that maybe write workers' compensation coverage or product liability coverage or medical malpractice coverage, where those duration of liabilities may last 5, 10, 15 or years or longer. So the duration is much longer. So the risk relative to reinsurance is much shorter because I'm recovering the money on a quicker basis than those companies are. So I'm able to talk to the CFOs and talk to these clients about the asset side of the balance sheet. And I said, okay, now let's talk about the liability side of the balance sheet. So what's your risk on, again, from a capital perspective on the liability side of the balance sheet is, what's the risk that your liabilities are understated? So I talk about the biggest liability for any insurance company is going to be loss reserves. So then I talk about what our actuaries say, where our reserves are, what the range is, where our reserves fall in that range, what our historical development has been. And so I'm able to help them understand that from a liability perspective, there's minimal exposure to adverse development from a liability perspective. So therefore, the capital that we have, if anything, is relatively conservative and probably understated versus overstated. And so that's the way that they approach the language. And whether you're a CFO or whether you're a CLO or you're president or whatever your job is, when you talk about it like that, people understand.
Yeah. Nice. Thank you for that. We're up to our final questions here. Which emerging risk, cyber, climate, supply chain, or something else, keeps you recalibrating your capital model? And how should CFOs prepare for that risk now?
Yeah, look, I think for us, it's different for me as a commercial property insurance company. I think you touched on two of them, and it's supply chain and not cyber. What was the other one you mentioned? Supply. Yeah. So those two are the two that have the biggest impact on my business because of like the loss cost and things I talked about before. Cyber is certainly a big exposure, but it's less of an exposure for us from a commercial property insurance perspective. It certainly is a big exposure I need to be aware of, as I manage the business. As I look at finance, you're looking at, think about, every day there's new tools out there where people are trying to find ways to basically get in and fraudulently get money. And so we're all constantly working with our treasury staff to make sure we're doing the right things. There's all kinds of things like that you have to deal with on a daily basis. But certainly cyber is less of an issue from a business perspective than the other two are.
What about just in regards to climate then? How would you recommend as an emerging risk, what lies in the years ahead? What should CFOs do to prepare?
Look, I think one of the things I would suggest is understand what your exposure is, not just today to the climate, the climate perils that are out there, right? But also try to understand, and this is information that we provide to our policyholders. Try to understand as the climate is changing, right? So as the areas that used to get rain are no longer getting rain, or the areas that used to be arid that are now getting more rainfall than they've historically gotten. What impact is that going to have long term on the locations on your locations where you are operating your businesses, and where can you then how can you then protect those facilities from a climate perspective? And those are the kind of services that we provide to help clients not just understand what your exposure is today. You certainly need to understand your exposure today. Don't get me wrong, but you want to make sure you're forward-looking, and looking out, 3, 5, 7, 10 years as to how the world is changing, because those are all things that are very predictable. So you need to take a longer term view of climate, because that's going to have a big impact, and it's hard to turn the ship. So it's going to take a long time to get where you need to get to if the risk is changing. That over a 3-year, 5-year period of time, if your risk of loss is going from a 1 in 500 occurrence to a 1 in 50 occurrence, you better making some investments, because there's a 2% chance you're going to have a loss every single year.
Okay, it's our final question. You'd like to know, what is the skill or mindset you want your finance team to strengthen before your next visit to the podcast here?
I think the big thing is I want them to continue to basically leverage the technology that's out there. As the technology changes, let's make sure that we are leveraging that technology. So we're making big investments in tech every day. Every year we're making bigger and bigger investments into the tech, and I want to make sure that we're leveraging that technology. I think sometimes we've fallen back to where we've basically kept doing the things the same way and not really taking advantage of the technology that's there. And as a result of that, we're making investments and not really driving the benefits for the organization. The other thing that I want to make sure that we do, and it's something that we started to focus on about 18 months ago, is really measuring and ensuring that we are achieving the benefits that we set up. Before we outlay any capital for any product, we sit back and say, what are the benefits that we expect to achieve? And then we got to make sure that we're then, as we do the KPIs on those, that we're actually achieving those benefits. And if we aren't achieving the benefits, let's pull the plug early on. Let's not continue down the path. So make the hard decisions earlier on in the process, and it's the right thing to do from a business perspective.
Kevin Ingram, thank you for joining us on CFO Thought Leader.
Thank you, Jack. I appreciate your time.